Double-digit dividends are rare. A sky-high yield of 27.2% is an outright income unicorn. Only in the merry world of closed-end funds, CEFs, would we see such a tale. It's enabled by talented money managers who, thanks to wide investment mandates, serve as the Willy Wonkas the CEF factory. These managers have an endless bag of tricks at their disposal. They can put options to work. They can double down on their own bets. They can double, triple and even quadruple the yield on traditional investing strategies, leading to average yields in the high single digits and stretching all the way to 27.2%. For real. But they still can't seem to get any respect. Just a few weeks ago, year-to-date inflows into exchange-traded funds (ETFs) eclipsed $500 billion, shattering 2020's full-year record inflows with 5 months to go, and putting the US ETF industry at a whopping $6.6 trillion in global assets and counting. That's a lot of money, and it still doesn't make ETFs the most popular investment vehicle on the planet, not by a long shot. Mutual funds account for roughly 3 times the assets, at $21.3 trillion. And CEFs? You have to squint to see them. No love for the CEF factory. The CEF universe is so small that it's difficult to even get accurate inflow data throughout the year. Closed-end fund assets stood at $279 billion at the start of 2021. Even at the same rate of growth of ETFs, they wouldn't be anywhere even remotely close to mutual funds or ETFs. In fact, the entirety of the CEF world would still be smaller than the SPDR S&P 500 ETF Trust (SPY), admittedly, the largest ETF by assets, but a single ETF, nonetheless. That's a shame. Because that's trillions of dollars that are missing out on what often is the superior fund type, especially if you're focused on income. Consider what all closed-end funds can do. I recently demonstrated that last point to readers, highlighting an incredible CEF that allows you to collect more than 6% annually while someone else trades Nasdaq-100 NDAQ options for you. But if that's too exotic for you, don't worry, you can still easily collect yields of between 7.3% to 27.2% in pretty straightforward equity CEFs. Have a look. ETFs with growth strategies such as the Vanguard Growth ETF (VUG) and Schwab US Large Cap Growth ETF (SCHG) currently deliver meager yields of roughly 0.5% each. They're growth funds. What else did you expect? I'm guessing you didn't expect 8% in annual income, but that's exactly what you get with Liberty All-Star Growth ASG, 7.9% yield. You also get a much wider view of the market than with VUG or SCHG. Liberty All-Star Growth actually combines 3 growth-style investment managers, one focused on large caps, another focused on mids, and the third with an eye out for small cap opportunities. It's an actively managed fund, so it's bound to play favorites. Tech makes up 28% of the fund, healthcare 24%, and consumer discretionary another 15%.